The last quarter of an engineering and infrastructure company typically happens to be a good one because of the lumpy revenue recognition and also the billing cycle. Now, this holds true even for HG Infra, which is a leading road construction company and which, despite the lockdown and the disruptions caused by COVID-19, was able to maintain decent growth in the March quarter. Well, in our ideas for profit today, I will discuss if investors should keep this stock on their radar for the long term. Now, while the full impact of the pandemic, availability of labor and also the delay of projects due to the lockdown will be visible in Q1 FY21, it is expected that the second half of the current fiscal year would be better and revenue loss also would get covered. Now, the company has already started functioning on its several of its construction sites gradually and expects to pick up pace in the coming months. Now, in Q4, HG Infra reported a good 7.4% year-on-year growth in its total revenues. Now, there was an impact of COVID-19 definitely leading to close to 100 crore rupees of revenue loss as well. Apart from this, since the run rate was good and the last few days of March did not have much impact of the revenue, it was still better off. In terms of profitability as well as the margins, they both expanded marginally because of the execution and also the large fleet of in-house construction equipment. Now, the company reported EBITDA margins of 16.3%. Also, profitability further expanded because of the higher other income and also the lower taxes as well. Now, HG Infra is known for its strong execution, the robust balance sheet also that it has. Now, while there could be disruptions in the first half of the current fiscal year as well, the visibility is strong, and once the pickup really starts, it will benefit significantly. Now, it is expecting that the financial closure of few large projects like Delhi, Vadodara bypass, Rewari bypass, if clarity really emerges on some of these projects, the earnings could definitely get a boost from here on. Now, in the March quarter itself, the company has bagged orders worth 2160 crore rupees, which is quite high considering the pace of awarding. Now, moreover, it is now sitting on an order book of close to 7100 crore rupees, which is 3 times its FY20 annual revenue, which provides a good revenue visibility from here on. So we do expect a marginal drop in the revenue in the current fiscal year. However, given the strong order book, the execution track record, and also the government's focus on road projects, there could be a strong rebound in fiscal year 2022. Now, even in difficult environment, what makes us confident is that the net debt to equity is still at 0.3 times, which is good enough to support growth and also execution, even if the working capital cycle stretches a little bit. Now, during the market crash, its stock had actually fallen to 135 rupees per share from 52-week high of 294 rupees per share. Now, while it has recovered from its lows a bit, even at the current levels, say about 190 rupees per share, the stock is currently trading at 8 times the FY22 estimated earnings, which is quite attractive at the current moment as well. So investors could therefore look at accumulating the stock for the long term.